Let's get right to the floor show and CFRA Research Chief Investment Strategist Sam Stovall. Sam, we'll tackle Iran in just a second, but what's behind investors' complete rejection of Alphabet and Tesla's earnings?
Sure. Well, hey, Liz, good to talk to you again. I think the concern is that maybe the earnings bar was set too high for this second quarter. The S&P up 23%, technology up 61%, and semiconductor is expected to post a 140% increase in year-on-year earnings. And at the same time, investors were very worried that these companies would get ahead of themselves in a sense like playing poker and anteing up in terms of CapEx spending, and that's exactly what's happening. So investors are getting antsy. They want to know when they're going to be able to show a return on that investment.
Are you saying that because some of these jumped above, their 200-day moving average, that suddenly investors said, you know what, we're maybe a little bit over our skis, let's take some profits?
Yes, I think that contributed to it. Like an army that gets too far ahead of its supply lines, you had the semiconductor equipment index 80% above its 200-day moving average. The chip index 35% above its moving average. It normally trades at 6% above its moving average. So it got well ahead of expectations and traditional trading. So I think investors thought, you know what, with any kind of bad news, let's take the money and run.
Well, not that we want to turn immediately to next week, because we've got Intel after the bell. And listen, Intel has had a pretty gangbuster last couple of months. So it's been possibly the opportunity to kind of change the narrative for the rest of the markets here. But that aside, we do definitely have some big names next week. Among them, I don't know, Apple, Microsoft, Amazon, Meta. These are huge tech names that could change the tone of the markets that we see right now. But maybe all bets are off if the Iran war ramps up.
That's right. Well, 4 of the 5 largest cap stocks that are going to report earnings next week are from the tech space. You could almost say that Visa is also technology related. 40% of the market cap of those companies reporting next week from the S&P 500 will come from the tech space. So I think there's an awful lot of news that's going to be driving share prices next week. So, expectations are we could see advances anywhere from 15% for Visa up to 75% that's expected for some of these tech players. So good earnings expectations, but like we saw with Alphabet, if you don't have sort of a tempered CapEx spending expectation, then those stocks could be hit.
I'll tell you, AMD is getting hit right now, down about 3.25%. It had come out with some headlines today saying that the total addressable market for its chips will reach $2 trillion by 2030. I absolutely believe Lisa Su, the CEO, when she says that, and she would never say that if she didn't feel like she had the customers waiting for those chips, correct?
Sure. And I think that most of the management will be telling you that the reason they're spending this much on capital improvements, et cetera, is to expand their business and to be able to satisfy the needs of these hyperscalers and other companies that demand their products, and that it is an investment today into their long-term growth. And that's why there still is likely several years left in this technology trade. But sometimes, like waves in the ocean, sometimes they move too far afield and then end up having to back off.
I'm liking your analogies. You said when the military or the armies get too far away from their supply lines. Very impressive. I'll tell you, I'm keeping an eye on treasuries. And this goes back to the oil issue at the moment. We've got the 10-year yield moving markedly higher than it was yesterday. And same with the 2-year. I mean, when you see that these treasuries are moving higher, at least the yields, that is a sign that the market believes perhaps that the Fed, Kevin Warsh, is going to be forced to tighten rates. Maybe not next week, because that's when we find out, at least for the month of July meeting, Wednesday, but perhaps September.
Well, that's right. The CME FedWatch tool right now gives a greater than 80% likelihood that we will see a rate hike in September and a more than 90% possibility of a rate hike before year end. And looking back over the last 50 years, every one of the new Fed chairs, their first rate change was a hike, not a cut. So looks as if we might be seeing that be carried through. Even going back to World War II, 8 of the 9 new Fed chairs raised interest rates as their first move. So with higher oil prices, CPI, and other inflation measures, as well as the yields themselves indicating the likelihood of higher rates, unfortunately, it could be a foregone conclusion.
Foregone conclusion. Well, it's not what the market would want, but who knows? It also means that, in part, we have a strong economy, at least for the moment. Sam, good to see you. Thank you very much.
My pleasure.